The broadcast is now starting. All attendees are in listen-only mode.
Good afternoon. Welcome to today's webinar presented by HSG. Today's webinar is Revenue Cycle Optimization for Employed Physician Networks. Obviously, if you're with a private practice, a lot of what we talk about today with revenue cycle applies there as well. I'm Neil Barker, partner with HSG. With me today is Davis Creech, director here at HSG. There's our pictures. Before we begin, just a few housekeeping items. Submit all questions via the webinar questions tab on your control panel, and we will answer as many questions as possible at the end of the webinar. We will not identify names and affiliations if you're submitting questions. If we don't get to your question, we can follow up via email and through your contact information. A video recording and the slide deck for today's webinar will be sent to you directly via email and also available for on-demand viewing through our website, hsgadvisors.com, by this time tomorrow. Now, as we get into the presentation, we like to start with a few learning objectives. So on slide 3, we've got highlighted 3 learning objectives. First, we want to talk about key questions that you should be thinking about, that you should be asking about your employed physician network's professional services revenue cycle, which is professional services is where we're going to focus. So on those professional services within the walls of a practice, as well as the professional services and just the professional services performed by physicians and advanced practitioners in a facility setting as well. Number 2, we want to learn how answers to those questions can help you optimize your revenue cycle. And then we'll talk about anecdotally some mistakes and things that we've seen other organizations and clients make, so that hopefully together we learn from others' mistakes and what not to do and what some of the best practices are with your physician revenue cycle function. So generally, when we talk about revenue cycle, this is kind of a picture representing what we're talking about. Everything that basically starting from the scheduling through verification, pre-authorization, registration at the front desk, charge entry, claim submission, doing the follow-up, posting of payments, and denial management. So basically everything from the time we schedule a patient till we actually provide the services and then receive payment for those services. So you may think that we could move coding before charge entry, but generally this is what we're thinking about, how we would represent the revenue cycle function.
The only thing I might add to that is that we're often asked what revenue cycle means to us. Oftentimes we'll go into a network and we're charged with answering questions. Well, revenue cycle is just the CBO's problem. And I think that's the wrong approach. In our mind, revenue cycle begins the day that you start recruiting a physician, and it ends the day you get a clean claim posted and paid, and anything that cascades in between that process. So as we begin the presentation, know that revenue cycle encompasses, in our mind, from credentialing to posting and paying. and keep that in your mind as we go through the slides.
Yeah, thanks, Davis. So on the next slide, as we highlighted in the objectives, some of the key questions. So the first question is really focused on basically increasing our collections according to our existing volume. So how can we, without increasing the volume, the number of patients that we're seeing, how can we just maximize the cash flow on the patients that we're seeing and the services that we're providing? So one of the first questions under that umbrella, if you will, is what is our current fee schedule? Are we charging enough? And you'd be surprised the number of times when we get called into a client, an organization, how long it's been since they've looked at their fee schedule. Same is true on the private practice side. I mean, a lot of times we've in our history here, we've done a lot of practice acquisitions. So we're getting into independent practices and looking at that practice for acquisition by a hospital. And always surprised at how long it's been since they've taken a look at their fee schedule and updated their charge master. Number two, we've got documenting and coding effectively, which we've noted is also a compliance concern. But from a revenue cycle perspective, are we leaving money on the table based on our coding? As we'll look at some of the slides later on, a lot of times physicians tend to more than overcode, they tend to undercode. We see a lot of times where they just fall in love with the level 3 office visit, and so you'll see 80–90% of their CPTs, whether it's established patients or new patients, coded as a level 3, and depending on their patient population and specialty, they're often leaving money on the table by not coding enough level 4s and level 5s. And so, coding and documentation is a big area that you need to be focused on. Are providers signing off on charts in a timely manner? Our physicians and providers, we'll say physicians a lot, but we mean advanced practitioners as well. Are they signing off on charts on a timely basis so that we can go ahead and submit the claim? Or do they have a number of patient charts that are sitting waiting for their review and sign off? Are we managing denials on the front end? Are we doing what we can to limit the number of first pass denials? And then on the back end, for those true denials, are we working those denials? Are we dealing with them so that we can bring the claim to resolution? What's our charge capture rate? How are we capturing the charges, and the products and services? And we say products as well because we're talking about any thing that we might dispense, any supplies that we might be using that we should and could charge for. But are we capturing all the services, or are things slipping through the cracks and we're missing revenue opportunity by things falling through those cracks? Commercial payer contract rates. Are we being reimbursed enough? Should we be looking at our what we're being paid by certain payers? Are we collecting co-payments at each opportunity? Once a patient hits the front desk, are we asking for those co-pays? As well as patient anything that's rolled to patient balance? Are we making an attempt to either collect or set up any kind of payment plans that might be needed for those dollars that are due directly from the patient? What do our adjustments look like? Are they appropriate, or do we think that our billing office is just writing things off, things that could be collected, but we're just writing it off? As Davis mentioned, on the front end, with recruited providers, newly recruited providers, are they credentialed and onboarded correctly and in a timely manner? and so we'll talk about that. Are we taking steps to mitigate the impact of no-shows? Are we double booking where we should? Do we contact the patients to remind them of their appointment? Are we rescheduling as necessary? Are providers and staff utilizing our IT system effectively? A lot of times we get in and we ask about training and they point to a DVD that's sitting over on the shelf and say that was our training, and so they haven't been trained appropriately on the system, which can create problems for revenue cycle. And is the system optimized efficiently? Does it work for the practice? Does it work for the particular specialty? Were the providers involved in any of the IT system build? What is our current payer mix? And basically, we may not be able to change the payer mix, but how does it, impact our expectations of what we should and could be collecting? Do we have enough staff? Do we have the correct staff? A lot of organizations that we go into, we see, we're on they basically staff according to what they think the practice has, earned at that point. What can they pay for? Which, can be self-limiting. If we don't have enough staff, we're not staffed for growth. And if we don't have the correct staff, the right people in positions, how's that going to affect our revenue cycle? And then communication, as in most areas of management, communication is huge. So are we communicating from the CBO to the front desk and into practices? If we're making mistakes, are we communicating the corrective actions so that we're not making the same mistakes over and over? And then how do we measure, monitor, and report metrics, important metrics, through dashboards? How is that reported, and then how is that communicated to management and staff?
Couple of quick items before we leave this. We ask you to ask yourself a lot of key questions there, and pay particular attention to that last bullet point, because we're going to talk about some management dashboards as the presentation goes on. But let's go back to the next to the last bullet point, talking about the front desk. This is a revenue cycle presentation, but I'm an old operator, and actually Neil and mine's mentor here at the firm used to say 80% of the world's problems can be solved at the front desk. If you have the opportunity to bring in some rev cycle people to your monthly or weekly management meetings, make sure that they're communicating with the front desk people, because oftentimes it's just a matter of revenue cycle team not getting what they need from the front desk or vice versa, and make sure there's a decent amount of communication going on between those folks. Sorry to interrupt.
No, thanks, Davis. So the next few slides, several slides, we're going to kind of look at some data points, as well as some of the output of analysis that we look at, that we go through as we're working with a network, either doing a broad network assessment with multiple components, of which revenue cycle is just a piece, a very large and important piece, but a piece of an overall assessment. Or, if we've been called in and asked to specifically focus on and help an organization or a practice identify issues with their revenue cycle and then make recommendations for performance improvement going forward. So we're just going to kind of look at some of the data points, and then some of the outputs of that analysis and that process. So starting on the next slide, just some of the next two slides, actually, just some of the key data points that we're going to ask for. So this is basically taken from one of our data request lists that would go to a client on the front end of a project. Obviously, some general information, which is important to talk about here, but just some general contact information, who we need to talk to when we have questions. But below that, getting into the details of the data, starting with, provider names, provider NPIs. An important point we'll point out is a taxonomy code, because that we've experienced situations where, I think in particular what comes to mind was in the ED or with hospitalists. I think particularly with ED, with physicians who were working in the ED, but maybe labeled as something else, as a family medicine or internal medicine physician, creating problems with certain payers when it came time to adjudicate those claims. Provider type, what's their specialty, FTE status, which is important when you get into doing some of the benchmarking, making sure that we're comparing apples to apples inappropriately. If somebody's, a partial FTE, we want to make sure that we recognize that and take that into account in our benchmarking. Are they new? When we're looking at their production and information, are they new? So what's their hire date? If they're no longer with the group, obviously. Moving on down, looking at, the charge lag time by provider, AR aging by aging cohort. We'll look at some data and some output of what that looks like. AR balance overall, claim denial rates, and then adjustments by adjustment type, which is, we mentioned earlier on, but is important to look at and understand what type of adjustments. Other data elements, obviously, we're going to be looking at the types of services and the work RVUs that are produced. You could also look at total work RVUs. We tend to focus on, because we're focused and concerned with the effort of the physicians and providers, we tend to focus on just work RVUs. But then you can see, some of the other items we're going to get into and look at staffing levels within the CBO and the practices to understand, staffing levels and how that might be a hindrance on the revenue cycle function. We talked about the charge master or fee schedule, as well as payer rates and number 7, and then some of the access metrics that you might want to look at as well. No-show rates we talked about, third next available appointment, and those sorts of things. Slide 9 here. So we're looking at just an example of some benchmarking of work RVU production. And so understanding how productive the providers are. And so we've highlighted from a mix of variety of orthopedic specialties, some work RVU levels benchmarked to survey data for that particular specialty, and how that production, how productive is a provider, so that we have that context going into the analysis where we're looking at other metrics. And obviously, there's going to be multiple metrics and multiple data points to tell the story. And so we want to gather as much as we can, because one metric's not going to tell us everything that's going on. So it's going to be multiple metrics that are going to tell the story. As well as when we're doing assessment, there's a lot of on-site work and discussions and observations that typically occur as well. And so that shouldn't be lost in, thinking about, assessing or reviewing your revenue cycle function, that the data can tell you a lot, but it's not going to tell you everything. And you're going to have to, get in there and, again, going back to those key questions, ask the right questions. So on this slide, just looking at some of the output of the data analysis, what are some of the key metrics that we might look at? So here we've got just some examples, looking at the gross collection rate, which is purely just the collections of professional collections of a practice or a provider, divided by the charges for those services. The net collection rate or adjusted collection rate, so factoring in our contractual adjustments, are we collecting what is due us? And you can see here in this particular example, if you look to the far right, the MGMA median for this particular specialty was at 94%. The closer you get to 99 or 100% is where you want to be. And so, the further away from 100% that you are, the likelihood and that typically is your bad debt. And so, in this particular example, we've got significant issue with bad debt that would be going on in this practice, which is why, you'll see the comparison at the 23rd and 20th percentile. So, significant issue there that's maybe telling part of the story. Collections per provider. So are we collecting on a per provider basis? Are we collecting what we would hope to compare and how we compare to our peers? So if we have somebody that's producing at a pretty high level, but then as in this example, they're not collecting, at a high level, what is that telling us about what's going on? They're working really hard, but not collecting, at a commensurate level. Collections per work RVU, so per work RVU produced, what are we collecting? And here you can see we're again, at the lower end. MGMA median comparison there would be about $79 per work RVU, and we're at the low 60s. So next we're asking the question, what's driving that? Is it a true revenue cycle function? I think the net collection rate might suggest that that's part of the problem. It doesn't mean it's all of the problem. As we asked early on, in some of our key questions, what's the impact of the payer mix, which is something else that would have to be looked at. How does that impact? Is it realistic to expect us to collect at $78 or $79 a work RVU? Maybe not based on our payer mix, but should we be able to close that gap and be 68, 69, or 70? I think that's part of the story that we'd be looking to tell, and part of the analysis that we'd be looking to understand. Days in AR, which is in this case is pretty favorable, but then that just leads us to ask questions about adjustments, because the days in AR can be influenced by the level of the type of adjustments that we're doing. So that's something else that again feeds off the other, and it takes multiple metrics to tell the story. Percent of AR over 90 days, just again a measure of how old the AR is, a favorable comparison here. And then the charge lag, there we're not doing so well. It's taken some time for us to drop a claim. And then first pass denial rate, there we're not doing so bad in terms of the comparison, but we may have internal metrics where maybe 9% isn't acceptable. We want to be closer to 5%, so that's always something to think about as well. AR aging, so this is just an example of one of the outputs. So looking at the AR by aging cohort, and what's the proportion or the share of our total AR that's in each of these aging categories. Obviously, as the benchmark data shows, you can see in the turquoise color the MGMA average being at 57%. Would be ideal, and that's where we would like to be, is have most of our AR in that particular aging cohort, having most of our AR being current, and less of it in the older categories. So in this particular example, we've got almost double, a little bit more than double of our AR being, above the MGMA benchmark of 13%. So we're at 28.6% on the most recent data in terms of AR over 120 days, which leads again to other questions. What's in that bucket? Knowing where this data comes from, the analysis shows that a lot of that is self-pay. It's AR that's been paid by insurance, and now portion is rolled over to patients, and so it's been sitting there. And so a lot of that probably either needs to be, we've attempted to collect it, and it probably just needs to be written off, or it needs to go to collection. So it's affecting the metric, but it's really not going to have, collecting it's not going to have, or dealing with it's not going to have a huge impact on cash flow. We talked about payer mix and is it a limiting factor, and what's the impact of payer mix? And so you can see here just some of the analysis that goes on looking at payer mix. In this comparison, we're comparing pretty close, to the benchmark in terms of our mix. But the next question is okay, within that commercial bucket, what's going on there? And who are our major payers, and what's the next step in our analysis if we still have some issues with our payer mix or with our revenue cycle? Looking at what we're getting paid by those commercial payers would be the next question that we would be asking. So this, to the right, we're basically saying, okay, within that bucket, where do we start? Where's going to be the most impact, the most bang for the buck? Who are our biggest payers that we need to understand what we're being paid for the services that we provide? And so with that, kind of looking at our charge master and comparing basically to 2 points, our highest commercial payer, as well as looking at how we compare to Medicare. Most payers base their fee schedules off a percentage of Medicare, so it's always good to compare to to current Medicare. And so you can see in the example here, we've looked at the current fee compared to current Part B Medicare, as well as our highest payer, and using those two data points to decide, okay, we need to either, we're fine to leave our fee for a certain CPT alone, or we need to increase it, and what do we need to increase it to? And so you can see here at the top, we've got a methodology where all our surgical codes are going to be set at 250% of Medicare, our E&M codes at 160%, and any of our imaging or x-ray services are also at 160% of Medicare. And through this analysis, we're assured that all our major payers in Medicare are going to, be above those percentages. So anyway, it's a good exercise to go through. Periodically, maybe not, if not annually, at least every couple of years, looking at your charge master and understanding what you're being reimbursed. Before I move on, just one quick point, because I think it's important to note too for hospital employed networks is the last question is have you added any new specialties or services? That's one that jumps to mind, that where we sometimes see issues as practices and networks, as networks have grown and added new specialties. When they add new specialties, new services tend to come into the mix, and services they may not have really given much thought into the level of fee. And so we want to look at that and make sure that as you add new specialties with new services, that the fee level there is appropriate. So lastly, before I turn it over to Davis, we mentioned, and I mentioned early on, the adjustments by adjustment type. So after we're looking at the AR aging and the days in AR, and we've said that, okay, the days in AR doesn't look too bad. The AR aging doesn't look too bad. Um, but really what's within those adjustments, what's going on? Are do the adjustments that we're seeing here, does that make sense? If we've got a high Medicare payer mix, then, it would be logical that our Medicare adjustment is at the top of the list. We've got a high Blue Cross payer mix, so it would make sense that Blue Cross contractual adjustments are at the top of the list. But does it make sense that our bad debt write-off is also up there? Does that really make sense? And should it be there? What are all their other adjustments and that sort of thing? And this is a pretty expansive list. I would suggest that we have in this case a much smaller list of adjustment types. Anyway, I think it's important regardless to dig in and understand what's going on, and then start asking those critical questions of your billing staff, and looking into the details and understanding are we foregoing revenue that we should be going after. So now I'm going to turn it over to Davis to begin by starting to talk about some coding and documentation.
Thanks, Neil. I told you that I was an old operator. So many years ago when I was running employed physician networks, the coding and documentation piece was largely meant to keep people out of trouble and to keep them out of compliance and to make sure we were singing the same song that our compliance department wanted us to sing. And that pendulum has swung so far to the other side that I think sometimes on the revenue cycle piece, larger networks miss the opportunity and leave money on the table because there's not been enough education on documentation and coding to the providers, both the APPs and the physicians. So this slide kind of illustrates that opportunity. They're a little high on their 3s and a little low on their 4s. So if you actually conducted some education and said, you actually have the documentation here that says you can bill a 4. We were at a client in Western Kentucky about a year and a half ago who, after we did this analysis, was leaving about $1.3 million or $1.4 million on the table if they had just provided some education for the providers. Do you do that? When was the last time you did that? And are there opportunities to educate the physicians? And then finally, what if there's a discrepancy in coding, and how does that get worked? Do you have coders in the offices? Is there a coding and billing embedded in the CBO? What is the communication if the doctor inputs it into the system and there's a scrubber in the CBO? What is the timeline that goes to? And behind that question is there a definitive standardized process and system to make sure that gets taken care of in a timely manner? So, all this, again, through the eyes of operations, but making sure that you have the right systems, approaches, and processes in place to see if there is a discrepancy, to make sure that how that's rectified. We told you early on to start thinking about dashboards. We've given you a lot. We're going to give you a lot of questions to ask yourself. One of the things that Neil is really good at developing is a standardized dashboard. And you can use these dashboards both with your managers, for yourself, and for the VPs of the system and the senior executives to measure and monitor where you are on a daily, monthly, weekly basis. They can be as big, if you have a well-run machine. I have some clients where we did some interim work where we had as many as 20 metrics that were measured. If you're not used to managing by dashboards, I would bite it off into a small take at first, 8 to 10 relevant metrics that you're comfortable that you can find a source of truth for. And I know that's easier said than done. Many times we'll go into a client and we'll ask, well, do you get metrics? And they say yes, and then we probe a little differently, and they're getting some from IT, they're getting some from the actual EMR. They're getting some from revenue cycle. They're getting some from the accounting department, and they're inundated and getting thrown all these reports, but they really can't turn them into information and actionable strategies. So take the time. It's going to take some time to develop if you're starting from scratch. Get those relevant people involved from IT, revenue cycle, operations, even the providers, and definitely include the front office and say, what are the metrics we need to be looking for? What can we know that we get accurately? And then review them monthly with your revenue cycle team, with providers and your staff. And getting back to the earlier comment, you know, the first answer that we always get is, yeah, we get all kinds of information. Don't just send that out, because people have a tendency to just put that in their to-do file and not look at it again. You know, callous the providers to understand what these metrics mean, why you're at the current state, how you can move the needle even just a little bit if one or two of these metrics moves, say, a point or two, how that financially impacts your setting. This is an example. This is one of Neil's dashboards, actually. This is an example of one of the dashboards we like to see. And we told you 8 to 10, and obviously there's more than that on there. But if you look at the rev cycle piece, this is an operational and rev cycle dashboard that we like to see used. But the rev cycle piece takes a look at 8 key metrics, and that's gross charges and collections, days in AR, what's your collection rate, what's your percentage in those buckets, what's your commercial, and then the collections per provider and the collections per work RVU. And some of those data points Neil already went through. This is just a matter of putting it all on one system and saying, okay, what's the variance from last year? What's our goal? And what are we doing right or wrong to get there? Neil, you may want to touch briefly on some of the operations and
Yeah,
throughput.
this is a pretty broad dashboard that, like the operations metrics, that's not something you probably want to look at on a monthly basis. The revenue cycle and volume, you know, throughput metrics, you know, I can envision this being while we're looking at annual numbers right there, you know, I can envision this being, you know, a month by month look, you know, where we've got numbers across the page, you know, columns for each month where we can kind of see the trends in each one of those metrics, you know, not so much for the operations metrics, which, you know, probably is for management to look at, you know, periodically. I mean, our you know, a lot of the overhead, you know, metrics that are up in the operations section, you're not going to want to look at that on a monthly basis because it's not going to change month to month. You know, staffing and, you know, building and occupancy and all of that kind of stuff. That's not something you want to look at monthly, but you know, somebody may want to look at it on a you know, management will look at it on an annual basis. But the revenue cycle and the volume and throughput metrics, you probably would want to look at, you know, month to month and show the trends, you know, in those metrics month to month, as well as, you know, year to date, compared to both perhaps a, you know, internal benchmark. I know with a lot of systems, Athena comes to mind. You know, you can get, you know, across the Athena system, you can get metrics that you can compare to, as well as your standard surveys, MGMA, Sullivan Cotter, AMGA, and so on. So you could probably even, you know, you could condense this down and just show the revenue cycle and volume. We kind of gave the, you know, the full picture here, but it definitely could be condensed, and there could be some metrics that you want to add to it that are relevant or that you have access to. I think third time to next third available appointment, you know, is one that, you know, maybe shows up in the volume throughput that we don't have represented here. That would be a metric that you might want to add to it.
Once you get people calloused, where would you like to do deep dives? What do you want to take a closer look at? The volumes, the charges, how many patients you're seeing, RVUs per month per provider, copay collections. this is low-hanging fruit. Copay collections, making sure, you got to start with a policy and a procedure. You got to have it standardized across all your physicians and all the offices and all the practices and all the specialties. But then the trick to that is holding people accountable for that, holding your staff and your management accountable for collecting those copays at time of service. It doesn't sound like a lot, $20 here, $40 there, but if you multiply that over a network of, say, 150 or 100 providers, that can add up quickly, and we want to make sure we're keeping track of and staying on top of that. The denials dashboard, again, getting back to process and procedure, make sure you have a procedure in place that says if we get a denial, who tells us that, who's responsible for making sure it gets cleaned up, what's the timeline for doing that? Is that the front desk person? Is that the office manager? Is that the actual provider? Take a look at why they're being denied. If 80% of your denials are registration denials, I might have a breakfast with your front office people and say, we're doing something wrong. Let's make sure we get this information when they're presented to us. And then the charge lag dashboard, all of us have wrestled with this with providers since the dawn of time. What is your stated policy? Do you drop charges in 24, 48, 72 hours? If that is the policy, then let's make sure the providers are held accountable for that. If they're not, what are the repercussions of that? And staying on top of that. So this is a list of some common mistakes, and we'll tag team this slide. We'll start at the top. We started out the process saying that we believe that revenue cycle starts the minute you credential somebody or the minute that a provider is recruited. I put this in there because it's top of mind right now, because we're dealing with so many clients. We have a client in Indiana now that came to us and said, we don't know what we're doing wrong, but we're not getting paid for these services. Turns out they had 14 providers that were not credentialed by the payers, and they were not credentialed for more than a year. So these folks were providing services, and back in the day, you could back bill some of them, Medicare, Medicaid, some of the commercials. They're not doing that so much anymore. So it's becoming more and more important and relevant to make sure that you have a checklist that you can tick and toggle when you're recruiting these people to say 90 days out, 120 days out, have we filled out all these credentialing forms? And it's not rocket science, but it is arduous. It's a very long and detailed process that requires some detail to stay on top of, but it can mean the difference in losing your shirt the minute that provider comes on board. We talked about the coding and documentation feedbacks. You want to talk about the CDI team allocations?
Yeah. I mean, having a team that and this applies to everything. I think in the revenue cycle, I think that we encounter is, and I think people are getting, at least our clients and the people that we come in contact with are getting better at it. I mean, I think probably 10 years ago for sure, we still had a lot of clients that had tried to adapt a hospital chassis, if you will, for professional revenue cycle. So really just having the foresight to understand that the dollars may not be as big, and as Davis has talked about, the dollars may not be as big, but the professional revenue cycle is important. It's unique, and it requires the attention that it deserves in terms of having the right resources, the right people, and the right tools for people to do the job. Again, I think it's not facility revenue cycle, but it's still very important.
We talked about the penalties for delinquent chart completion. Make sure you have a policy in black and white that gives you some teeth to enforce that. Quick story, you're going to hear a case study in a little bit about a client we had in Ohio, and at the same time we were doing what what we'll tell you about, we were actually doing a physician leadership council engagement. And we had a couple doctors that were 200 and 300 charts behind, and we couldn't get them to move. And peer-to-peer pressure is always better. Once we brought that to the leadership council of physicians, and they found out one of their colleagues was that far behind, they applied some of the peer pressure. So don't be afraid to do that. When you see suits like me and Neil and some of the people on this call coming, sometimes a doctor will shut their ears, but don't be afraid to engage a champion and help move that needle a little bit.
And I'll just say too, I think that, peer pressure is obviously very, very good as well, and can help move in the right direction. But we're seeing more and more people kind of revise their physician compensation model and put more dollars into other metrics other than just eat what you kill. Looking at tying dollars to those types of metrics. If that's an issue, then maybe there's a percentage of their compensation that's tied to how they're scoring in those metrics and chart lag and getting things done so that we can bill for it, as well as not making sure they don't get the RVU credit until that happens. So peer pressure is obviously very, very good and can, as I said, move the needle, but probably wouldn't be surprised that when you turn it into dollars, that can really get it going in the right direction.
Making sure you have the right people in the right seats with coding oversight. You can debate all day certified versus non-certified. I would not get hung up in that argument. I would concentrate more on, do they know what they're doing, and is the right policy in place, and is there right communication for those people? Not enough staff at the front desk and billing office. We do a lot of staffing analysis. It's no secret that sometimes the best and well-oiled machines are a little overstaffed. Don't be afraid to, I know it's a tough time to do this, but don't be afraid to ask for staff, because it can sometimes help you pay for those things and get the right people in the right place. Working denials it's a pitfall. It's a common mistake. It's easy to put up there. More importantly, just make sure you have the communication. Again, it goes back to, what is the revenue cycle team communicating back to the front office or the office manager, and how are you measuring and monitoring that, and making sure you have the right documentation for those denials. And then, co-pays and point of service collections, we beat that horse. It adds up. So let's talk quickly about a case study. This is from an employed physician provider group in Ohio. It was about 140 providers. They had about 19 or 20 specialties. Quickly, we were charged first to go in and be the interim operator for that. They needed a VP of physician services to go in and help them figure this out. That started as an 11-month process that we embedded somebody on site with their senior team. So once we got them situated operationally and talked a little bit about what they needed to do financially and get the right people in the right place, we made some organizational structure changes. Then we actually hired somebody to replace us in those 11 months. Once we got that person hired, it was clear that one of the topics, Neil said earlier, when we go in and do these assessments, revenue cycle is usually one of the bigger and first priorities we attack, just because there's a return on investment, and it's probably the one that you can see the most financial gain in. Revenue cycle was the one that created the most problem here. They were bleeding pretty badly, and they had everything. We went through and we did the analysis that Neil asked you to do just in this presentation. And after we fiddled and faddled with that data, we looked at where the key areas of focus should be. And basically, it came down to reorganizing the CDO. We identified how they could increase and streamline their processes, and it came down to, they had it organized by practice. And so that meant that one person might be contacting Blue Cross Blue Shield and 5 people might be contacting the same person, and there really wasn't any continuity. So we went in and we totally restructured their CBO and organized it around process and systems of what we think the revenue cycle process should be. So there was an insurance verification team. We created a coding and charge posting team, claims processing. So we organized the CBO around processes and not practices. And what that did, and I'm not going to lie to you, we also added 8 people to that because they were staffed in their CBO like they were still a 30 provider network and they had grown to 140. So the bottom line was we spent many hours with the CEO there trying to justify the ROI on adding 8 people to this mix. Once we did all that, we reorganized, we got those 8 people trained. We let them work in the CBO and started reporting up through the revenue cycle team. And the payoff slide is the next one. And quarter over quarter, we saw a little bit more than $1.7 million increase in our quarterly collections. Now, obviously, you can't sustain that quarter to quarter, but that was just the first quarter pickup. Our collection rate increased by about 9%. Some of that was a little catch up, but it was still going to be about 7%. Our days in AR went down 5%, and we lowered our denial percentage just by reorganizing the CBO by process instead of by practice. So it can be done, but that process in total took 19 months. It's not going to be done quickly.
So as wrapping up here, kind of summarize. We've highlighted, the key questions that we think you should be asking. We've highlighted the right data that you need to collect, that you need to look at. We've talked about, diagnosing your current state revenue cycle, identifying the gaps through the analysis and benchmarking. Doing a deeper dive as necessary. We've talked about, the looking at, what makes up our adjustments and understanding that, diving deeper into denial rates and understanding what's driving that, communicating that information back to the front desk, diving into charge lag and understanding, who are the culprits there, what can we do about it, peer pressure or with incentive compensation type structure. We've talked about the difference between hospital or facility based revenue cycle versus professional fee revenue cycle, and advocated for giving professional fee revenue cycle the attention and the resources that it needs in order to be successful. We've talked about early on, updating the charge master and in situations where that rises to the top, for example, adding new specialties and services to your network. So new services that didn't have fees or just had placeholder fees before. The focus on coding and documentation and its impact on the revenue cycle function as well as our compliance concerns. And then communication, having that dialogue and that open communication between the providers and the staff, explaining the data and the dashboards that they're going to see, not just making it available on a portal or sending them a report, but occasionally having them understand what you're trying to do and what the data is telling them, and those sorts of things. And then again, identify key metrics and measures through the use of dashboards. So getting to questions, I think we've got 2 questions so far. First one says, are there metrics that you would recommend always be on monthly dashboard, even if the process isn't perfect to gather the data? I think one thing we always say is don't let perfect get in the way of good. Davis's reference to a former partner, I think that can probably also be attributed to him. But I think that, you know, the previous slide that we had with the initial dashboard, obviously, as I mentioned, the operational metrics, you know, probably don't need to be on your month-to-month dashboard. But I think, you know, most of the revenue cycle and the volume and throughput metrics, I think those are good ones to start with. And you may have some that you have available to you as well. I think particularly if you have some access through your system, if you have benchmark metrics that you can compare to, I think is a good place to start. Second question, how do you determine what is the correct number of billing staff is for a group with 100 employed providers? It's not an easy question. I think, you know, Davis talked about how they work, either by practice or, you know, by function. I mean, I think that's a consideration. I mean, there are, and we tend to look at benchmark ratios from sources such as MGMA. They have staffing ratios per provider and per work RVU. I think, you know, together those can be directional and kind of let you know where to start, how you stack up, and, you know, if there's a significant variance, you know, I think that, you know, that probably, you know, tells you something. You know, and as you talk to people, does what you're hearing match up with what you're seeing through the data? Again, I think you take all, you know, inputs together before you make a decision. I will say that, you know, we tend to, you know, really want to look at, you know, for revenue cycle as well as for the clinical staff, you know, look at the volume-based metrics. So, you know, the staffing metrics per work RVU, and what does that tell us? Because particularly in a high volume practice, you know, or area, you're going to need some, you know, some additional staff to handle the volume. So hopefully that is helpful and answers the question. I think that's all we have for questions. Just double check. Yep, I think that's all we have for questions today. If you didn't get a chance to ask your question, then feel free to send us an email, reach out to us. I think you can get to us through our contact us section of our website. So we'll just ask you to do that, and we'll get back to you with answers to any questions that we didn't get to today. So we'll move on with our closing remarks here, and we'll say that we want to thank you for participating in today's webinar, and hope that you can join us for any future webinar events. You can see here some information about upcoming webinars, July 23rd, August 13th, and the 27th, the different areas that we'll be touching on, in the world of physician networks and hospital relations. So hopefully you'll be able to join for one of those upcoming webinars. You can register for any of the webinars through our website. You can also register for the entire series also through the website. And again, as always, feel free to contact us directly or visit our website at hsgadvisors.com. And we'll close out by saying have a great day, and thanks for joining us.